Hello, it's Scott Bennett and Mike Olafson with Invest with Rules. I'm excited to dive into the midweek update, the blind corner. Proceed with caution. Let's dive into what's going on today. We actually have a really interesting topic, which we're going to cover. Is we've actually had two great clients and members actually have brought this up. So it's mainly about the concept of buy and hold, selling into strength, and trend following. So we have a lot to cover. Before we do, world's quickest disclosure. This is just information. It is not a direct solicitation to go buy or sell anything. Please always manage your risk, manage your financial plan, do your due diligence. That's really important. We've just seen over the past roughly few weeks how incredible risk happens really fast. So please protect yourself and do your homework. So, Mike, I'm really excited to cover this topic. We try our hardest to be responsive, to be transparent, to share what we're doing and why we're doing it, and then that will hopefully help members to come up with their own thesis, their own rules to be stronger in the market when the market's really hard. So, what we're going to cover is which strategy is better. And Mike, why don't you set us up? And then we're going to go through the math and a back test to answer the really difficult questions, which let's be clear that every market cycle has its easy parts and its hard parts, and it's trying really hard to solidify which philosophy is right for you. And a lot of for what we do is based on statistics, probabilities, and math, not how we feel. And there's a really easy way to say, like, should I switch strategies? And let's go through that. So, Mike, set us up and we'll go through some slides together.
Yeah, in fact, I'm going to go right to the punchline. There is no better strategy for all. There's a better strategy for us. And we'll get to in a few slides to show you the better strategy for us, but something just like Scott said might be different for you. So what we're going to do over this simple this simple back test is look at three strategies. The first is the good old buy and hold. So you buy something, hold on to it for dear life, and you sell it years or whatever it is down the road, whatever your time frame is. Second is taking profit, and this is the one that Scott alluded to, where we've had a couple of clients and members say to us, "Hey, Scott and Mike, why don't you sell proactively, sell into strength when you hit like IBD does this or promotes this, Bill O'Neill, where you hit 20%, 25%." Go ahead and sell and then move on to something else. So that's what we're going to look at in the middle scenario. And then the third one is kind of what we follow. We really believe in classic trend following, where you get a buy signal and then you ride that trend as long as it takes you. Are you ever going to hit the exact bottom and the exact top of the trend? No, clearly not. But you want that meaty middle, and that's what our signals get us, is the meaty middle of that trend. So that's what we're going to take a look at. And of course, just it goes without saying that there's so many other strategies. There's mean reversion. It's just that's what makes the market fun, is there's so many different strategies. But it's fun, but also painful too, to figure out which strategy works best for you. With that said, let's now jump into the back test. So this is a simple back test, a 20-year back test going back to 2004, looking at these three strategies. And so the results you see on screen, we're going to hit the compounded annual growth rate first, the CAGR, CAGR. So the buy and hold strategy of buying the Qs. So we're going to say Qs, NASDAQ 100. The buy and hold strategy gets you a CAGR of 13.3% over the last 20 years. Pretty darn good. The take profit strategy, and this is using an 8% stop loss. And then once you get to 3 times your risk, your 8%, 24%, you sell proactively and move on. And so that gets you a 10% on the dot CAGR for the last 20 years. And then trend following, our concept of letting the winner run, gets you a little bit better, a 10.1% CAGR. So you might say, well, Mike, we want the 13.3% CAGR, but that brings us to the next criteria, which is the max drawdown. Drawdown is basically the simple concept of, you hit a peak of here. What does your account or the strategy, what kind of hit does it take during this 20-year period? What's the maximum hit it takes? Buy and hold, no big surprise. The max drawdown for the Qs was 53%. And I'm pretty, if memory serves, that was in 2008. So 53% drawdown if you were in buy and hold. Take profit, you're at 32%. And using a simple trend following, the trend following strategy we use for this example, to keep it simple, is a 200-day simple moving average. So basically, you buy above the 200-day when the Qs are above the 200-day, you sell them when they're below. And that yields a max drawdown of 22%. So here's the key. Which would you rather have? Which could you handle? Could you survive a 53% drawdown? Could you survive a 32% drawdown or a 22% drawdown? Personally, for me, I'm in my 50s in my current situation where I've done accumulating and now I want to protect and grow. 22% is a lot more palatable to me than a 53% drawdown. Scott, I've been kind of throwing out a lot. Let me pause before we get to the last piece. Any points of clarification or anything that you would highlight?
Yeah, in this example, we're using market in out is the source of the data.
Yep.
And very, very simply, we took invest with rules out of this. This is just conceptually the strategy. And obviously, buy and hold is the most tax efficient, take profit is the least tax efficient, and trend following somewhere in the middle. And again, the 200-day simple moving average is some people do it. The news loves to talk about it. When everyone does it, it probably doesn't work as well. But I think that's back to max pain, max drawdown. I'm just going to hit one point, the 200-day simple moving average versus invest with rules, since might as well, this is a good time to cover it. So invest with rules, we have a short-term signal and a long-term signal. And the long-term signal has some closeness to this example, but our short-term signal is significantly quicker. And when you combine the short-term and the long-term together, what you're getting is very simply less of a max drawdown. And what you've seen over the past few weeks is we went from pretty exposed to the market to, I don't know, we're going to cover it on a future slide, but I mean, 60% off the table, hedging, partial positions. I mean, we have really de-risked fast. And in general, that's the reason how we're able to outperform. Again, this isn't perfect. Nothing's perfect in a market where if you go look at most funds out there, you look at most tactical strategies out there, you're not alone. Everyone got hit. The question is, how hard did you get hit?
Yeah.
Because this came from the top. It didn't, like, if we bounce around where we're at now, and we'll talk about that in a future slide, could it get significantly worse? Sure. But I think this is a good, just, we're even more defensive minded than a traditional 200-day simple moving average. And I'll move to the following piece, but any other pieces there, Mike?
Yeah, no, great clarification, great kind of perspective there as well. And that's a great way to kind of move into the last piece of this, which is something that a lot of folks look at strategies different ways. Some of you may have heard of the Sharpe ratio and various different ways to look at strategies. I like to keep it simple. And for this simple back test, we used what's called an MAR ratio, but simply what it is, it's your average return divided by your drawdown. And the reason why that ratio is key is the higher your return is, the higher your ratio is going to go. The lower your drawdown is, the higher your ratio is going to go because your divisor is lower. And so bottom line is the higher your ratio is, the better the strategy is, because you're getting higher returns for lower drawdown risk, or as Scott called it, pain. So with that said, buy and hold gives you a 0.25 ratio. Not great. And ideally, you want to get the closer to one you can get, the better. If you can get over one, fantastic. Take profit is 0.31. And the simple 200-day moving average trend following is 0.46, significantly better. So that's really the bottom line. Somebody might go for the 13.3%, buy and hold to maximize that kegger, but then have to suffer that pain of a 53% drawdown. Whereas somebody doing trend following minimizes the drawdown and maximizes the kegger and gets a ratio of 0.46. And so that's why I said at the beginning, that this is the better strategy for us and many of you, I'm sure, that you want to kind of balance the two, minimize the pain, but also get some decent returns. Scott, anything else to cap this off?
I would give it the old Simon Sinek why. This is we want a smoother ride.
Yeah, yeah,
We want to make money, but we don't want to feel horrible. And if you want to feel horrible, if you go on Reddit and you look at people who own alternative coins in the crypto space right now, like I mean, Bitcoin's been wiped. Some of the like Tesla's been wiped. A lot. Some of these are down enormously large percentage. That's what we don't want. We don't want huge drawdowns, and that's where we're at. And if someone's incredibly young and they're buy and hold, that's totally fine. But there is still a better opportunity, a better spot for when to add versus just sit there and lose half your portfolio. So I'm going to move over to our invest with rules data. So Mike, thanks for doing that. I really appreciate it. Again, we're not here to prove we're right, and this is
yeah,
our why. This is our why. Could one
exactly.
do another strategy? Of course. You could do a million strategies. You can combine them all. But the reality is that some work really well in uptrends, and some work really well in downtrends, and some work really well in choppy markets. And over very long cycles, we have found this works the best for us. That's how I would say it. And then compartmentalize that for you. So right now, a very strong uptrend is a 10. A very horrible downtrend is a 0, or we'll call it maybe a 1. We're at a 3.5, teetering between 3.5 and 4. And why is that? What we're simply doing is we're looking at the S&P 500, which is on a break signal, short-term and long-term downtrend. The NASDAQ 100, the QQQ, is on a break signal. The small cap index, IVV or VTWO, the Vanguard small cap, I think I got that ticker right. That's on a break signal. And here's, lo and behold, international stocks are still on a gas signal. So short-term, long-term uptrend. That's what's holding that score up. If the international wasn't doing well, you'd be down in the doldrums over here. And you can kind of see the chart of the S&P 500 is we very simply we have exited small caps. We've exited tech. We've exited, or we've actually hedged, which we'll cover a little bit in a bit. But this is tough. I mean, this is just a straight shot down. And in theory, this morning you're trying to get some version of a bounce, and some of it even sold off in this morning. So can we get some sort of a bounce back up to here's your lo and behold, your 200-day moving average? There's a probability that this thing just kind of rolls out and over. So that's where we are very defensively minded right now, and we were doing that all in here. So this is calendar day 16 of a short-term downtrend. The S&P is now down 6.3% from that signaling on the 24th of February. We're actually on this would be in theory day 1, but day 2 of a long-term downtrend. So we're getting even more cautious, not more aggressive, based upon the math of the trend. You can kind of see here our percent invested, and some of that is things like gold and international and some very defensive sectored stocks. Mike, any thoughts before we keep moving?
Yeah, great recap. I think let's dive in.
Okay, sorry, I wanted to stop here for a minute, and this is a monthly chart of the S&P 500, and this is like, remember that when we used to go into the mall and it'd say like, you are here on the directory? This is where we are. This is a monthly chart, and it looks kind of similar. I mean, at the end of the month, we still have the end of March to go. Could you get some sort of a reprieve and form a bottom wick over here? But you're just over here. So if you got down to the midpoint, that's what gets you into the correction territory, minus 10% from all-time highs. Could you get to the bottom of the channel? That gets the S&P 500 even further, possibly looking at this, what we'll call somewhere in the neighborhood of a bear market. So in 2022, you had interest rates rising fast. That was the answer. The market overheated, there was inflation, they rose rates. Today's different. Today is very simply you have tariffs that are now turning into trade war. Again, non-political. This is reality of what we're dealing with. And then also you have the Department of Government Efficiency, the DOGE, cutting government spending fast. That cuts jobs, that creates unemployment, that stops the spending. The last, call it 7 to 10 years, has been a lot of government spending. That is turning the spigot off, which is recipe for a very sharp, painful move that we've already seen so far. And could it get worse? That's a possibility. So all the way to the left is the weakness, all the way to the right is the strength over the past, we'll call it 14 or so days, 2 weeks. International is your lone ranger on gas signal. That's why we're there. Staples, real estate, utilities, interest rate sensitive off to the right. Off to the far left, discretionary. That's your Tesla, Amazon bucket. Small caps, S&P in the torture. Look how many breaks there are. On the bottom row, your only gas is Berkshire Hathaway, and you now have Eli Lilly, NVIDIA, Microsoft, Tesla, Google, all on breaks. This is tough. This is a bad environment, and it could always get significantly worse. Mike, any thoughts?
Yeah, and under the surface, it's actually even worse. When you look at, any of the members can go to our tab showing the Big Fund 50, and you'll see under the surface, especially those growth stocks, which the Big Fund 50 has got a decent amount of, you'll see it's even worse. So this tells a story, but then there's more.
Yeah, and we're obviously being cautious on that report because trend and signal overweight the flow of what the funds are buying. We need to be defensive. So
Yeah.
half positions, and we've been really cautious, and we're waiting for a bounce like you. So here's what we're doing. We're still just want to sum it up. Three things. We built a lot of cash. Today you got the CPI, the Consumer Price Index report, and inflation's coming in lower than expected, which is expected. So you have GDP slowing because of tariffs and Doge, and you have inflation. I know that sounds like it's going to cause inflation, but not yet. Inflation and growth slowing, that's deflation. That's what this market is undergoing. And it might undergo it for longer than you think, meaning Q1, possibly Q2, until the data starts to turn more positive on growth, as long as this gets kind of seeped into the market. We have hedged using the NASDAQ 100 and the S&P 500. Could we always hedge more? Sure. This is the point where usually I think a lot of people are thinking this, it bounces and then you further protect. We haven't got the bounce yet. What are we holding? International stocks, gold, fixed income, defensive stock sectors. That's kind of where we're at. So playing defense is the theme. We've been doing this for a while. Mike, thoughts?
Yeah, quick question for you, Scott. And you love it when I kind of throw you curveballs, and this may be a straight up, but maybe a curveball. What's your take? And we obviously we avoid politics except as it relates to what's going on in the market, which sometimes is quite significant. But without getting into the politics of it, what's your take on the notion of potential recession coming? And the fact that really there hasn't, that came up, I think, this weekend from the president, and there's been nothing the past 2 or 3 days to refute that necessarily. What's your take on that, and with regards to the macro picture?
Well, it's tough because I mean, the traditional sense of a recession is two sequentially down GDP quarters. But then on our last cycle, that was taken away, that definition. So I think the definition of a recession is maybe not the most perfect fluid thing to track. We do we follow our trend roadmap, which gives us signals which are really clear. I mean, if you really go back, I mean, it's really clear that it's helpful and it tells you the short-term trend, it tells you the long-term trend. We put them together. So I think, in our opinion, that's my opinion, that's where one should focus. It's based on math. It's not based upon opinion, or they can't take away an opinion of math and data. And I think the hard part is a lot of these models that forecast, that do these GDP nowcasts, that do these inflation nowcasts, it's hard and they get them wrong. So that's why we focus more on trend and signal more than anything else. But the question is it going to be a recession? It's possible. It's not off the table. You're in a deflationary downtrend spiral at the moment without any sort of reprieve. So I'll give you things that need to be taken off the table in order to get the most incredible V-shaped recovery, like a COVID-like recovery, is you need Doge done. You need tariffs just like, okay, we're done for now. Just we're gonna pause them 6 months, we'll deal with it later, or something where right now you kind of have them and you take them away. and you throw them out 30 days and you take them away. And it's on the car companies, it's not on the car companies. And then it's like, okay, now we're getting reciprocal tariffs from Europe and from Canada today. It's uncertainty, and the market hates it. So recession, it's possible. It's very possible. I think what matters more is protecting capital in a downtrend. So
And Scott, I love what you said about the fact that opinions, what's the expression? Opinions are like, you know what, everybody's got it. But you can't take away the math. The trend roadmap, the trend is clear and nobody can refute it. So you're absolutely right.
yeah, I want to go over just quickly what's on our watch list. Again, we're being incredibly cautious. So when it comes to stocks and ETFs in a second, we're looking at this universe of companies that are strong companies that are all subject to the whims of the global markets. They're all tied to as the basket moves, but we're looking specifically at fund buying. That's what we're focusing our time on. We're focusing on earnings growth. We're focusing on volatility adjusted momentum. There are no stocks on the list this morning. It's all ETFs and it's all precious metals and commodities. And why is that? If you were to go out to Q3 of this year, you're going to see slowing growth and rising inflation. And if that's the case, that's the recipe. So they're front running this, expecting that this pullback won't be so hard. So, and gold tends to kind of think of it more like a currency than anything else. I heard it was an interesting kind of a podcast. I forget which one, but there's always this fear that other non-US economies are going to stop using the US dollar and and they call it the BRICS nation. It might be like, so what are they trading? They're trading gold. And that's why we have gold. That's why gold has survived so well the last couple of weeks. So anyway, here's your list. That's what's going on. So I'm going to show you a few charts. Sometimes you can explain them really easily, and sometimes you just simply can't. The first one is this is physical copper. This isn't copper stocks. This is physical copper. So the piping in your house. Short-term uptrend, long-term uptrend, still on a gas signal, breaking out. Do you want to piece together something about the housing market? Maybe. But the reality is, this is a really strong trend. It's a bit extended. It just broke out. Any thoughts on copper?
Yeah, it's kind of some of these are head scratchers, but yeah, let's
Yeah,
keep
that's
going.
a head scratcher for me too.
Yeah.
Gold, we own it. We still have a full position. It's done nothing wrong. Short-term, long-term uptrend. I'll go through these relatively quick because I was super long-winded previously. Silver miners breaking out today. Short-term, long-term uptrend, looking perfectly fine. Could it, in theory, in this terrible environment, kind of sit back down on the trend line at some point and then make another run? That's probably more likely, but that's my prognostication.
Mhm.
Physical silver trying to break out today. Short-term, long-term uptrend. That's tied to the silver miners. Silver doing really well. GDX, we have a position. Short-term, long-term uptrend. We have a half position. We'd love to maybe at some point add a full. Could this one join its friends at some point? As long as gold keeps its momentum, hey, why not? So GDX looks interesting. I'm going to stop us there. So hopefully that was interesting, thoughtful, helps you kind of conceptualize your thinking. But again, we want to thank you for being a member. We know these are tough times. We're not telling you this is not your traditional newsletter where we're just like buy stocks and hold them for 3 years and hold your nose. No, no, no. Follow trends, follow signals, follow risk management rules, follow big money when it's working. The trend trumps it. Again, if you have questions, hello@investwithrules.com. We greatly thank you for being a member. If you're like, this is painful, I'm not implementing this, I need some more help. If that's you, just reach out to us, hello@iwradvisors.com. Mike, final words as we sign off on Wednesday's midweek update.
Quick thing, Scott, but quick thing, it bears mentioning that we've received feedback from some of our clients, and it's actually kind of gratifying and eye-opening that hey, you're doing what I couldn't. Thank you so much. Meaning that taking action, for example, in what's been going on in this market, I couldn't do that, and I wouldn't know how to do it, when to do it, how all kind of good stuff. So that's it's gratifying, but that's kind of where we come in, where many members have their plan executing, but if you're stumbling, kind of wondering how to handle it, that's where we potentially come in with the advisory. Once again, not saying you have to, but it's just something to consider if you are having a tough time right now.
Yeah. All right. So thanks for that, Mike. I'm going to just wrap up again. Thank you for your time. If you have questions, hello@investwithrules.com. Thank you again. We'll talk soon. Bye-bye. I hope this helped you kind of identify some either uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com. Thanks so much.